Welcome, I'm Catherine Magaña here with Steve Wolff, Rachel Ivanovich, and Greg Carroll, where we're here to provide you insights on the stock market, bond market, and planning and taxes and much more. Over the last week, we are still talking about the Fed, tariffs, earnings, taxes. I mean, a lot of hasn't changed, but right. But we thought we'd kind of get you up to speed. So it looks like Trump is visiting the Fed today, so that's kind of interesting, and we'll see what his comments are about the renovations on the building. And I know there's been some comments about that recently. Talking about the Fed, it looks like the Fed is the odds of a rate increase are less than 3% for this month, and then the odds for September of a rate cut are about 64%. So we'll see what happens between now and then. Looking at earnings, so far 88% of the S&P 500 companies that reported earnings per share, they've actually posted earnings above consensus. So 88% of the S&P 500 companies have posted earnings above consensus, and 67% have beat revenue. So there's still some earnings being reported, obviously, that we're still looking at. And then we have taxes, which Rachel will chime in a couple items there. Looking at mortgage rates, they're pretty much holding pretty steady right now. They're at about 6.74%. I was also looking at kind of some of the short-term rates. It looks like one-year CDs right now are at 4.2, which is a little higher than the last couple months. And then also kind of giving a quick update of where we're at with the markets. So over the last week, the Dow Jones is actually up, and year-to-date we're up 5.8%, and that's as of yesterday's close. Yesterday was July 23rd, and today is July 24th. The NASDAQ is up, it's up to about 8.85% year-to-date. The S&P 500, a little over 8%. And the Russell 2000, which had the biggest move over the last week, year-to-date is up 2.38. It's still lower, like we talked about in the past, than some of the other indexes, but it's starting to come back a little bit over the last week.
Well, and that's a good thing, too. If it spreads out from just the Magnificent Seven, the
tech
stocks,
yeah.
the big tech stocks.
NASDAQ in general.
Yeah, and now you have some of the smaller stocks starting to do well, maybe some of the value stocks even. That's a good thing.
Well, and then what's on the headlines again, which is interesting because we haven't seen this since 2021, is there's the meme stocks that are coming back. So
yes.
That's always interesting because they tend to move pretty quickly up and very volatile.
Yeah, they're usually pretty small companies that are heavily shorted.
Yeah.
And these groups apparently on these chat rooms get in there and they just go, let's everybody buy. And it requires the people that are short to buy the shares. So they're all buying, and then the stock goes through the roof for a very, very short period of time.
Yeah, and for all of our clients who say they want to buy those meme stocks, you're on your own on that one.
Oh, yeah. we don't do that.
Well, I think there was even a movie about this that came out a while back. But
recently.
Yeah.
Yeah, and you said that President Trump is going to see Powell, the Fed chair, today. By the time you get this, you probably know what happened.
Yes.
But it's interesting because I believe that Trump happens to be right about lowering rates. I think that Powell is behind the curve as he was on the way up. I don't like the way he treats him necessarily. I don't like, bullying him, but I think he's right. And I was just reading something from the Zacks organization, which are a stock analyst firm, and this one person whose name is Mayor Thaker says that the Fed's behind the curve at cutting rates. Prices paid by manufacturers have risen to the currently elevated levels and even much higher than today, dozens of times over the past 60 years, of which most instances do not lead to material higher consumer price inflation. Alternative readings of consumer prices such as Trueflation, which is something I'd never heard of before, so this was new to me. I want to say, what's Trueflation? It's an alternative to using the CPI. And according to ChatGPT, which is my new best friend, what is Trueflation? Trueflation is a modern, real-time inflation tracking system built on blockchain technology and decentralized oracles. It aggregates millions of daily price points across various categories like food, housing, transportation, and more to deliver daily updated inflation index as opposed to the monthly lag of traditional measures like the U.S. Consumer Price Index. So it's kind of interesting. Here we go. AI is changing how we're going to do this. But the point is that I think that inflation is staying relatively tame. And I'll be honest with you, I was one of those people that thought that inflation should be much higher than it is, but the tariffs are not doing that, at least not yet. We're coming out with deals I think we just came out with a trade deal with Japan yesterday, and that really powered the market. We have a deal in place in structure with China. And the other thing that's happening is that the deficit is starting to decrease. It hasn't gone to zero or below, but over the last 3 months, which maybe this is a trend, the amount of the deficit is going down and down and down. So we're about half of what we normally would be for the last 3 months as far as that deficit is concerned, if you look at it historically. So, you can complain a lot about Trump, and I hear a lot about it, but maybe he knows what he's doing. I got to give him credit until it goes the other way.
Yeah, it's still early in the game, but yeah, it does seem to be like going in a pretty good direction. And I'm surprised that a lot of these trade deals, like you said with China or Japan, was at 15% tariff on their
I believe it's
goods?
reciprocal 15%.
15%, yeah, and 80% of their goods they send us are cars. So, and the market's actually like that. A lot of the car dealerships or producers were up big yesterday.
Well, it's not just tariffs, because with Japan, you have never seen a U.S. car in Japan,
right?
Because they don't allow it,
right?
That's part of the deal that they've made. So it's not just about you're charging us tariffs and everything else. He's saying you're not being fair as far as trade is concerned,
right?
If we've got a better product, or if you've got a better product, why don't you compete in the marketplace?
Correct. Yeah, and it seems like Europe has got close to a deal, and they're at 10 to 15%. I never would have thought we would have been in this range when this is all said and done. But it's a different regime here.
This is important. I mean, this is the macro look where you're looking at the big picture of the economy. That doesn't necessarily tell you how earnings are going to be and how each individual stock is going to do. But if you can even the playing field for a lot of companies, and you're bringing more manufacturing back to the U.S., because the last couple of years our manufacturing has really slipped, all right? And what Trump is saying is we need to get that manufacturing back in the U.S. If those things happen, that's good for companies. It's good for their earnings.
Absolutely.
How is it for taxes?
Well, there's a new car loan interest deduction for cars that are assembled, the final assemblies in the U.S., if we want to.
Do we have any idea how many are actually assembled here in the U.S. final assembly?
I have no idea. Maybe next one you can report out on that, Steve.
Well, it's interesting. I've actually had a couple of clients call this week. I know
several
everyone's
clients have
buying
called and
cars
asked.
right now,
And they want to know if they're going to be able to deduct their loan interest. So you basically have to look at what your income is, because if your income is over $100,000 and you're single, no go for that, and then $200,000 for married filing jointly. And of course, you have to buy a new car. You can't buy a used. It doesn't apply for a used car. It has to be a car purchased in this year. And again, like I said at the beginning, final assembly of the vehicle had to be in the United States. So
I keep hearing this.
This is up to $10,000. Sorry.
I keep hearing this complaint that everything that this Trump policy is doing is for the wealthy people.
I was thinking the same
Yet
thing.
almost everything excludes the wealthy people. Now, the one big thing has been the estate.
Yes.
Where, yes, you can do a lot more, but that certainly helps people who have businesses and farmers.
Yeah,
Yeah.
a lot of these deductions and interest things and everything,
Absolutely.
it gets phased out pretty early.
Right.
As far as income goes.
Most of the thresholds are pretty low, under $250,000. And for the car loan interest, it's $200,000 if you're married. But to recognize the estate planning and what's going on with that is the federal estate and gift tax exemption for 2025 is currently set at $13.99 per individual.
Million.
$13.99 million.
So $13.99.
Just clarifying.
Just being clear.
Yeah, and the tax rate remains at 40% for estates. So money in estates, it gets accelerated very quickly. Your taxes accelerates pretty quickly. So it has been raised to $15 million per individual, and they've made it permanent, and it is indexed for inflation. And this is for estates starting January 1st of 2026.
So what permanent, as we learned.
Yeah.
Is until they change it.
Until the next law comes along.
Exactly. So permanent is it's
It
interesting.
is a fine line between something expiring and permanency.
Correct.
Because, like the tax laws were going to expire, but now they're permanent until they get changed.
Until they get changed.
Yeah.
But
Exactly.
again, this is good for business, though, because now they say, okay, it's going to be in place for the next 3 or 4 or 5 years, whatever it is.
At least you can plan.
Exactly.
Yep.
So we can plan on what to do, because up until now, a lot of the businesses, especially the bigger businesses, didn't want to do that because they said, well, what if things change?
Right.
Yeah.
So
They were waiting on bonus depreciation was a big one that they were waiting on, which they made permanent and brought it back up to 100% because it was at 100% bonus depreciation, which means if you buy assets for your business, you can write them off in the year that you purchase them against other income. States typically don't comply, so you have to plan for your state tax law separately.
So then going back to the conversation about car loans.
Car loans,
it's
yes.
really a matter of each individual situation. Do you have money to buy the car? Do you want to finance part of it? What are the rates? How is it invested? So it's not just, hey, go buy or lease a car. It's kind of looking at the details. And then once again, do you qualify for the deductions or not? And then, so that's, those that aren't currently owning a business, but for those that own a business, it's a whole different
Picture, because if you do own a business and you use that car for business-related purposes, you can deduct up to 100% on that interest and depreciation on top of it, gas, insurance, et cetera. But, it's case by case.
So going back a little bit toward why I think this is pretty good as far as the macro is concerned, is that over the past 2 or 3 years, the majority of new jobs have been government jobs, okay, which means you have to have taxes to pay for that. Now over the last, it's actually been over the last maybe 6 to 7 months, maybe 8 or 9 months, so it started a little bit before the Trump administration, but the growth in jobs is now in the private sector, which to me is more permanent, and you don't have to worry about, how are we going to pay for this? Because the companies are paying for that. As long as business is good. And right now, business is good. So going back to valuations of stocks, stocks are valued high right now again. I think the PE is somewhere around 22 or 23 times on the earnings on the S&P 500. So historically, that's extremely high. So I'm not sure how much longer the stock market rally will go before there's a correction. There probably will be. I don't think that's anything to get crazy afraid of. But right now, you've got it pretty high. Now, I've said this before. I think that the range of low to high may be higher than it used to be. And the reason for that is there are almost half the stocks on the stock market as there used to be. Yet there's more money chasing those stocks. So it wouldn't surprise me if instead of saying 23 is high, maybe 30 is high. I don't know. I'm just making up numbers. But it could be that the higher end is higher and the lower end is higher because of that dynamic.
Where's the fear and greed index this week?
I'm glad you asked that question. The fear and greed index is just barely, it's at 76, which is just barely in the extreme greed section. Okay?
which is in line with where we're at with the returns year to date and
Exactly.
Yeah.
the sentiment of everybody right now.
Exactly.
Yeah, so it
Probably be a little more cautionary at this point, given the fear and greed.
Right.
The meme stocks we talked about earlier, P's historically high. It's not the time to have FOMO, I don't think, but
FOMO meaning?
fear of missing out.
Okay.
And I think there are people out there, I get that sense that there's a little more of that happening. And it's usually a time when maybe the market takes a little break, 3 to 5%, maybe a little more. But that's just part of a good, healthy market.
Well, Vince isn't here today, so I'll pretend I'm Vince. The growth stocks are still where the action is.
Yes.
AI and all its related, industries are still they're growing like crazy. And I would assume that will, the technology will continue to do that at least for the next 2, 3, 4 years. So.
And the amount of money those big companies are spending on, all these chips and manufacturing facilities and equipment, I mean, it's
right, but
fueling a lot of other parts of the market.
But it's not a straight line up.
No.
Okay, it is very volatile. So if you're going to be in that type of an industry, you've got to accept that, you could be up 100% and then down 50% or more, and then back up 200% or something like that. It's going to be volatile. If you can't accept that, if you cannot accept that volatility, don't be in those.
Sounds like a meme stock.
Right?
Up 100, down 50, up 200.
Take a look at some of the best stocks we have.
Right.
They were up and then down maybe 50%, and now they're up 75%.
Like what they've done since the early April lows.
Exactly.
I mean, it's been quite the run.
Right.
Yeah.
Quite the run.
Quite the run.
So we said we were going to talk about Trump accounts on this episode. Last week we said that, didn't we?
Well, let's talk
Go
about
ahead.
it. Well, there we go.
I wanted to hear what you think about them first before I jump in.
About the Trump,
Yes.
where he's giving $1,000 or the government's giving $1,000. I'm not crazy about it because of all the restrictions there are in there.
So many restrictions, yeah. So in essence, the government's going to make a one-time $1,000 tax-free contribution to an account for any child who has a Social Security number, born a U.S. citizen in the U.S., I guess, if they were born 25 through 28. I guess it's a pilot program. And if the parents don't open up the account...
2025 through 2028.
2025 through 2028. So they're calling it a pilot program. Just they want to see how this is going to work out. And there are a lot of restrictions on this. And honestly, the tax code already provides at least... Well, I've got 7 that I can count, tax advantage savings vehicles, and they all have different rules, different restrictions, different limitations. And so this is just one more that we can add to the list. So for instance, we've got the traditional IRA or 401k. So there's that one. Then we've got the Roth IRA or 401k. We've got 529 tuition plan accounts. We've got health saving accounts or HSAs. And now we've got the Trump accounts. So what makes this unique and special, other than the $1,000 contribution that it's tax-free, is they're really tricky and complicated. I don't know if you've read up on them at all, but
I've read up on them before they became law, and so it's probably changed.
So you can put in $5,000 per year, but not just you as the parent, but contributions can be made by relatives or friends or even the employer, and you're going to have to track. So the taxation on it is also very odd.
Are there child labor laws on the employer contributions?
No.
Okay.
Well, baby, I don't know. That's off topic. So
Only
You
if
said
go-
the employers. I mean, these kids are just born.
well,
Only
but, I
if you
mean,
go
that's
in-
an interesting statement because in order to contribute to a traditional or Roth IRA, you have to have earned income. So, okay, fair. But in this case, I don't think, I mean, the parent probably has to have earned income. And so there's some interesting drafting with this law, which may make it to the point where the employer can only put $2,500 total in the account and not $2,500 per year. But that annual $5,000 annual limitation, that if the employer makes a $2,500 contribution, the parent or relative can only make $2,500 contribution as well. At least that's the way it's currently drafted. But what gets tricky is if the parent puts the money in, then that is considered basis, meaning it's an after-tax contribution, and later that portion is not taxed again. If the employer puts the money in, then you have then you have to track that. And so then all of the earnings as well. So it's almost like a non-deductible traditional IRA with a weird Roth twist. So
Sounds like a drink that I had last week.
after reading this, I almost had to go to the bar to recover from it. Just kidding. But they're literally, I mean, it's going to be really tricky. And what they're saying is effectively from the age 0, when the $1,000 goes in, to age 18, or actually 17, there are no withdrawals allowed at all. Once the child or young adult turns 18, then it effectively becomes like an IRA. An IRA or an individual retirement arrangement rules govern. So that means between 18 and 59 and a half, if you pull money out, it's considered an early distribution, and it's subject to tax on the portion that wasn't contributed by the parents or that first $1,000. Because the first $1,000 is, I'm telling you, like, you cannot make this stuff
How in
up.
the world
Who's
are you
gonna
going
keep
to
track
track
of all
all that?
that?
That's what I'm
Who
saying. Like, my
contributed?
clients can't even remember what they had for breakfast sometimes. And so I'm like, how on earth are they going to be able to track all this
Come on,
stuff?
I know for sure your clients can remember that.
Well,
I
They're all
can't
smart.
remember.
I haven't even had breakfast yet.
I'm kidding. But it's really, these are tricky beasts.
So is there going to be a WWM financial account where we
I don't know.
start with 1,000?
Catherine, Steve, what do you think? Yes, absolutely. I like that.
Only kidding. Oh, it would be great. Maybe put it all in crypto or something, and it goes to the movie.
So one of the things that I think is interesting about these is IRA rules govern, meaning once the child turns 18, you can pull the money out without a penalty to pay for college. Or should we do a 529 plan? So I think the flexibility with 529 plans is greater, but I don't know.
Yeah, I'm not thrilled with what they're doing. I mean, I understand the original concept was to have
encourage
everybody at
savings.
least have a savings and understand how the system works.
Start to grow their wealth at an early
but
age.
they're
yeah.
putting so many restrictions and twists and everything on it.
But isn't this similar to why the government came up with 401ks, was to encourage people to save for retirement? I mean, isn't this the similar idea, but yet it's starting at age 0?
Yeah, I think the 401k was also a way to take some of the burden off corporations, and pension plans, so that you could start saving, force you to start saving for yourself. And now you look at Social Security, which is maybe not on the most stable ground, so you really got to start saving, for yourself. If you got to look out for numero uno.
That's where I
to
think
retire.
That's where I think they wanted to take the pressure off of the government.
Yeah.
So get
Sure.
your own retirement account. You
Right.
won't have to rely as much on the government.
Yeah.
Which, as far as I'm concerned, is great. But there are a lot of people who do need help. I mean, it's okay
Sure.
to have that, but
Yeah.
that I think that's where the pressure.
You just
was.
can't have so many rules like that. That's
There's so many.
That
Yeah.
just that kind of hurts thinking about it.
Yeah, and the money can only be invested in a qualified mutual fund. I mean, there's other restrictions, and that mutual fund, let's see here, can't have annual fees or expenses more than 0.1% of the balance of an investment in the fund.
So basically,
So
it
it
means
means-
you're putting it into an S&P 500 index fund.
Exactly.
Which is fine.
Yeah.
I mean,
But yet another restriction on it.
Yeah.
Whereas with 529s, is it similar? I don't.
it's similar. That's
you know,
mostly mutual funds, but
Yeah.
there's no
An
expense
index,
ratio.
I mentioned
Regulation.
Crypto.
Yeah.
I mentioned crypto here just a second ago. The government is now really starting to get into crypto with new laws, and actually, cryptocurrency and all the things that go with it, the blockchain, and all the whatever that is.
There's some interesting tax regulations that are coming with it. So more on that later.
Oh,
With crypto,
With crypto.
investing.
Yeah, and how they're going to treat it and how it's going to be taxed. And
Well, but it's giving it a more of a legitimacy. I mean, a
Yes.
year or two ago, people would ask about cryptocurrency, and you'd say, well, is it going to be around? But once the government starts, regulating it, at least it's going to be there.
well, we'll talk about
So.
the taxation on it maybe on the next podcast.
Ooh, taxation on cryptocurrency.
Can you wait? I can't wait.
I can't. All right. Anything else going on? No, that's going to be it for this week. We will see you next week. Thanks for listening.
All right. Thank
Okay,
you.
Thank you.
thanks.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.